Now to the question at hand, David Kretzmann. Paul writes, I had a question about the Gardner-Kretzmann Continuum. I'm 38 years old, he writes, with a GKC score of around 0.7. And if anything, I would like to make it lower. I had read in the past that individual investors tend to perform best when they stick with their highest conviction ideas, and expanding beyond that tends to dilute performance. That makes sense to me, Paul says, and it's why I've always tried to stick to between 20 and 30 companies. That also seems to go with the rule breaker philosophy to me. Why would I want to invest in my 31st best idea when I could just add more to my 2 or 3 best ideas? So can you tell me where I might be wrong, why more positions are better? Thanks again for all that you do, Fool On, Paul.
Awesome question. And I think it's something that we repeat a lot of times on this podcast and other podcasts. Your mileage will vary depending on your own situation,
Absolutely.
your own preferences, risk tolerance. So there's not necessarily anything wrong with having a GKC score below 1, which Paul, in this case, has. I think most individual investors should shoot for a GKC score of about 1, just to be thinking in terms of broad diversification within your individual portfolio.
And let me pause you right there, David, because I know we have some new listeners since we last talked about the GKC, which we seem to do every month or two on this podcast. So could you briefly define our term, the Gardner-Kretzmann Continuum? What does 0.7 mean?
Sure. So the Gardner-Kretzmann Continuum is probably lapping its 1-year anniversary at this point, if I'm not mistaken.
I've heard rumors that it's being considered for the Nobel Prize in Economics. It's put
excellent.
Both Gardner and Kretzmann in a position, I'm not going to say a pole position, but potentially to win the big bling, that hunk of metal that I always imagine the Nobel Prize must be. Obviously, modesty can sometimes escape us, but David, what is the Gardner-Kretzmann Continuum?
Sure. So this is really a simple score. So you take the number of stocks that you own in your portfolio and you divide it by your age. So as an example, let's say you own 50 stocks and you're 25 years old. Your GKC score is calculated by dividing the number of stocks that you own. So in this example, 50 stocks divided by your age, 25 years old. So in this case, your GKC score would be 2.
Above 1. Not
Above
only,
1.
Well above 1.
Yeah.
That's remarkable. So you have a lot of stocks given your age.
A lot of diversification for your age. So if you're 50 years old, you own 50 stocks, your GKC score is 1. And generally on this podcast, over the past year or so, as our GKC score has evolved, David, you and I have thought, well, maybe you don't need to aim for just 1, but ideally 1 or higher.
Yeah,
and really,
1.0 is kind of the golden mean. And the way of thinking about it is, you know, if you're 25 years old, maybe you should have 25 stocks. I'm 52. I have about 52 stocks. There's no one way to go here. That's why it's called the Gardner-Kretzmann Continuum.
And some people will be below 1 and they'll be perfectly comfortable with that.
Like Paul.
And to Paul's point, the question of, you know, is it okay to shoot for 20 to 25 stocks? There's kind of the Warren Buffett adage or quote that's out there where he says, you know, you should really treat buying stocks like you're punching a card where you only have 20 boxes to punch or check, essentially meaning that over the course of your life, invest as if you're only going to buy 20 companies. And I think the meaning behind that quote is to really focus on buying quality, great businesses that you want to own for a lifetime, which is something we aspire to do as fools. But on the flip side, in our recommendation services like Stock Advisor or Rule Breakers, or really since the Motley Fool launch with you and Tom over 25 years ago, the focus has really been to continue following and recommending stocks week by week, month by month, and really trying to continually explore the world of business out there.
Absolutely.
And try to find all the quality businesses out there. So I think now in Stock Advisor and Rule Breakers, we've probably, recommended over 300 companies over the past 2 decades
Many
or
of
so.
which remain active recommendations. But yeah, and in my experience, David, now in our 3rd decade of the Motley Fool and having been there at the very start, having met so many individual investors of all stripes in many different countries, and David, you're now head of Motley Fool Asia, so you especially know that better than I. But in my experience anyway, the mistake most people make is they are not diversified enough. They do not have enough stocks. So it makes me far happier to see somebody with a lot of stocks than with just a few stocks. And Paul, I think 0.7 is just fine. You sound like a savvier guy at the age of 38. You've got less than 38 stocks. And if that's working for you, that's great. If you want to keep adding to your winners, we like that too.
Yeah, absolutely. And I think that this is all directional more than anything, trying to think in terms of more diversification, not less, especially for beginners. I think that a common mistake is to only buy 1 or 2 or 3 stocks. And that way you're just so emotionally invested in those companies, you're more likely to follow short-term movements in that case and potentially get spooked out of the market or just get the wrong idea that, hey, one of my stocks jumped 30% this month. I'm really good at this. I'll just keep doing this, rinse and repeat. So,
yeah.
And I think one of the benefits also of owning more stocks is it just encourages you to pay attention to the world maybe a little bit more closely. Your portfolio doesn't get stagnant. So even if the new stocks you're adding represent less than 1% of your portfolio, you get a little bit of skin in the game and you can follow along, especially with a year like this where you have a lot of new companies coming public. You have Lyft and Zoom and Uber and a bunch of different companies.
Pinterest.
Hitting the public markets, Airbnb. So having skin in the game, I think, encourages you to follow along like an owner and can make it a little bit more fun.
Absolutely. So again, thank you, Paul, for a great question. And there is no one size fits all. That is why it's the Gardner-Kretzmann Continuum. And we, of course, have fun with that. But we're deadly serious about the point. Each of us should be maintaining a well-diversified portfolio. And that phrase can mean different things for different people at different stages of their life.